Ladies and gentlemen, good day and welcome to the Q4 and FY2024 results conference call of Gulf Oil Lubricants of India, hosted by Emkay Global Financial Services. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions at the end of today's presentation. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I would like to hand the conference over to Mr. Sabri Hazarika from Emkay Global Financial Services. Thank you, and over to you, sir.
Yeah, thanks, Sejala, and good afternoon, everyone. On behalf of Emkay Global Financial Services, I welcome you all to the Q4 and FY24 post-earnings conference call of Gulf Oil Lubricants India Limited. We have with us the top management of the company, Mr. Ravi Chawla, Managing Director and CEO, and Mr. Manish Kumar Gangwal, Chief Financial Officer. So without any further delay, I would now ask the management for the opening remarks, and then we'll move over to the question and answer round. Over to you, sir.
Thank you, Sabri. Good morning, good day to everybody. Thank you for joining us on the Q4 call. We are very happy to share with you that this has been a record-breaking quarter for us in terms of our results and our achievements. It's definitely an excellent quarter. We've maintained our growth momentum, and this is the third quarter in a row where we've crossed our EBITDA of 100 crores. In fact, 115 crores is the highest EBITDA for the company ever. So a strong quarter end, as March is expected to be with all our programs and our initiatives going on. So really happy about that. To add here, obviously, that our EBITDA margin sequentially went up 13.5%, tracking towards the higher band, which we talk about 12 to 14%. Definitely margin management efforts, increased focus on cost and focus on premium products helped us to get us there. So these were the highlights. The growth has been majorly driven by a lot of double-digit volume growth in infra and B2B, as the press release we have released. Overall, of course, our B2C sale also showed very good growth, and in the quarter, and good uptick in the motorcycle oils, the commercial vehicle oils, and agri segment, which is really beginning to show a good demand across, as you are seeing in other industries. Also, rural demand is picking up, and we have seen that also happening in March and then continuing. We've also seen that it's been obviously, if you look at the annual performance, we've seen our EBITDA crossing the 400 crore mark, reaching 419 crores, growth of 22%. And definitely that's a good sign for us. We've also seen a lot of good gain in market share overall in the year, with our bazaar segment growing, led by agri and new generation commercial vehicle oils. Happy to also share that our car stops and bike stops, which is a key initiative for us, have also experienced strong double-digit volume growth in terms of secondary sales. And overall, our distribution focus and distribution in retail segment has paid off. We've grown double-digit in that, both in rural and urban areas. So overall, annually and the quarter, I would say very satisfying year that has happened. And in terms of volumes, we have closed the year with 2x the market growth. And in the quarter also, happy to share, we have achieved 37,000 KL in core loops. And of course, we also have the highest in AdBlue this year, where we did 37,000 in AdBlue. So both combined 37 and 37, coincidentally the same figure for both. While the growth overall is 3% in the quarter, because factory fill, as we've been sharing, has dropped by double digit, and I think that's more due to the production for OEMs. Without the factory fill, our 2x market growth has been 7% in the quarter, and in the year also we are close to that 6.5%. So I would say that 2 to 3x mantra which we have in terms of market growth we have maintained. So a good quarter again, once again, led by a lot of investments in the brand, continued push in terms of all our businesses, B2B, B2C. We are also doing a lot of digitization, other efforts. I'll now hand over to Manish to take you through some of the other details which he can highlight. Over to Manish.
Thank you, Ravi. Good afternoon, everyone. As Ravi highlighted, it's been a very good quarter for us, all-round performance. And of course, our profit after tax on the back of a solid EBITDA has risen by 37% to 85 crore. And also for the full year, the profit after tax is 308 crore, which is again 33% growth nearly on a full year basis as well. So overall, very good year and quarter from that perspective. At the same time, our margin management, as Ravi was highlighting, has been robust, and we have improved our gross margins by nearly 3.5% over the year. And sequentially, we see a slight dip because the crude was volatile during Q4, and we have seen nearly a 1.6% drop on the gross margin level sequentially, but we have been able to deliver the same EBITDA, almost 13.5% for the quarter, in spite of the slight dip in the gross margin. That is, having said that, we have always been focusing on margin management. So all the actions are already being taken to continue to be robust on the margin management side. We have announced the price increase in our retail segment just now, and also in certain B2B segments we are taking the prices up already. So that is on the margin management. A very robust cash generation from operation, 348 crore of cash during the financial year generated out of operations versus 273 crore last year. So very healthy cash generation continues with effective working capital management and overall delivery by EBITDA. And based on this cash flow generation and the profitability, the board has been very happy to announce a higher payout and the final dividend of 1,000%, which is 20 rupees per share. You will all recall that we have just in February paid an interim dividend of 16 rupees. So with that, the overall dividend for the year is 36 rupees, which is 1800% on a face value of 2 rupees. So overall, I think the journey on returning good cash to shareholders continues with a higher payout this year. And with that, I think we will be happy to take questions from the participants. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Probal Sen from ICICI Securities. Please go ahead.
Yeah, thank you for the opportunity. Am I clearly audible?
Yes, Mr. Probal.
Yeah, thank you for the opportunity. Sir, congrats on a good set of numbers. I have 3 main questions. One, if we look at the margin scenario right now for this year that we have done.
Sir?
Yeah?
May I request you to please use your handset?
Hi, am I not audible?
Yeah, slightly we are not hearing there is some
Noise, sir. There's some
Sir, is this better, sir?
Yes.
Absolutely fine. Yeah.
All right. Sir, just first question was regarding the margin environment. Now, if we really go back a little bit and look at the kind of margins we earned over FY16 through to FY21, just wanted to understand, sir, that in the current input price environment and with the kind of pricing we are seeing across our portfolio, what would it actually take for us to go back to that environment, if at all feasible? Is it what I'm trying to get at is a margin improvement to that extent even feasible, or we should look at a more steady state, gradual margin growth over what we have achieved in terms of EBITDA margins this year? That was my first question.
So, yeah, I think, Mr. Probal, I understand where you are coming from. We have been delivering 16% EBITDA margins in the period you mentioned, roughly 16% to even sometimes 17%.
Right, sir. Yeah.
And we have explained in the call earlier also, and for the benefit of everyone on this call, you see the input cost increased during the post-COVID period significantly. And for that, we had to take series of price increases and our realizations went up. while the per liter margin we have been able to recover fully what we were in the period which we are mentioning 5 years ago, the percentage looks lower because you are dividing numerator and denominator by the same amount. So if you take on per liter basis, actually for the core lubes, we have already recovered those margins and we are in the similar band. Secondly, overall for the company as a whole, the margin slightly looks lower because our AdBlue volumes have picked up significantly, which we all understand is a slightly lower margin product. So this is a blended margin as compared to earlier when it was more, mostly 95% plus 98% was only core lubes. So in spite of that, we have been able to deliver this kind of margin in the 12 to 14% guided band. We actually dipped to 11% in one of the quarters, just before, but we have been able to recover from there significantly, and now we are tracking nearly 13.5%. Of course, always there is a premiumization which Ravi talked about, and there are product mix and there are continuous improvements, and there will be an sort of, I would say leveraging effect, operating leverage will also keep coming in, which will help us to move back to the 14-16% band, but that we will have to really, take it as a future target.
Understood, sir. And the second question, of course, was about the volume growth. Now, I think Ravi sir also talked about the fact that volume growth, even in this year, if we take out the factory fill portion, is probably at about 6 to 7%. But on an overall basis, therefore, sir, is it fair to assume that for the next couple of years, given that factory filling will remain a fairly large portion, or at least a material portion of our business, that low to mid single digit growth is what we should be working in on an overall basis? That's more realistic to assume.
No, so basically, factory fill is only 10% of our volumes. So it's not a very significant portion, but if that 10% dips by nearly 20-25%, we will have an overall impact of 2-2.5% on the total.
Understood.
But our trajectory, our guidance has been to grow 2 to 3x the market growth, which we have done in the last year as well, and we continue to aim that. So if the market, let's say, gets some tailwind and market grows at 4%, we will definitely aim at a double-digit growth. And if the market is at 3% or 2 to 3%, then high single digit. That's what we are currently aiming at.
Right. The third question was, sir, with respect to, and this obviously gets asked to our company as well as others in this space. In terms of EVs, on the ground, what are our activities right now? Any update you can share with us? And also, if you can kindly share whatever revenue we did from the battery segment for this year, if feasible.
Yeah, so on EV, Mr. Sen, let me mention that the EV fluids business is a very small business, not half a percent of the volume, but we are with about 10 OEMs now, looking at another 5, 6, so that's going to be continuing our EV fluids journey. And as we are investing in the chargers business in Direct, and we've also got Electrify, a software company, we are looking to grow that part with our EV business. And of course, in the battery business, we have done, I think this year we'll be at about 80 crores, and we are looking at toll manufacturing local product and looking to grow that business quite aggressively going forward because a lot of touch points are coming in. And that continues to be part of our Gulf Pride brand extension. So I think we are hoping that that also grows double digit, and it will. So this is where we are with both these businesses. And just to add to your other point on the what Manish was trying to explain, you see, for us, our mix is B2B and B2C. We as a company are focused on various segments. So in order to maintain the margin and be competitive, we want to grow all the segments that we are focusing on. For example, OEM. For example, industrial. Where our market shares, we have great opportunities, for example, in industrial. OEMs, we are pretty strong. We believe in the private sector, we are amongst the leaders. So that is why our margin band is what it is, because we have to compete and grow. So, that's probably what I want to answer. Yeah.
Great, sir. If I can just get one last question in, sir. In terms of just the immediate year, in terms of FY25, if I were to talk about our strategic imperative just for the next 12 months, anything specific you would like to highlight that we should take note of or keep track?
Manish, you want to...
Sorry, in terms of, sorry, can you come again?
Yeah,
I was just saying, just from a next 12-month perspective for FY25, sir, any specific strategic moves that we should be aware of or we should be keeping track of in terms of our company? Obviously, you've laid out a broad strategic vision in any case for the next few years in terms of how you want to grow. But just for the immediate 12 months, anything specific we should be looking at? Any OEM tie-up, any specific segment growth that we should be looking at? Just wanted to get more of a sense in terms of, how to build more granular growth for FY25 in particular. Any color you can throw would be useful.
No, I think our core strategy is to get that 2 to 3x growth. Within certain segments, we see the opportunity to be greater. So we have some market segments where our market share is about 8-9%, like motorcycle, like commercial vehicles. Even there are opportunities, but there are certain segments where our market share is below 5%, like passenger car.
Right.
In the case of, passenger car, in the case of industrial. So these are the segments where we believe we can grow much faster than the 2 to 3x. So I would say that's one call out. The other is premiumize and offer value products. So both we'll do. And there's a lot of digital efforts happening in the company, which will also fructify in terms of both customer value creation and benefits. So these are the three themes I would call out. And the fourth, of course, very important, which has now become our sixth strategy, is the focus on EV. So both with OEMs for EV fluids, we're also looking at the charger business through Tyrex. And that's going to be another focus where, we mentioned in the press release that it's been a good, closing for them. So next year we are pretty charged up, so as to use a word in terms of the DC chargers. So we will be looking at a good growth. So I think these are the 4-5 new call-outs.
All right, sir. Great. That is extremely useful. Thank you so much for your time.
Thank you.
Thank you. The next question is from the line of Prakash Kapadia from Spark PMS. Please go ahead.
Yeah, thanks for the opportunity. 2 or 3 questions from my end. For the financial year, out of the approximate 33 billion sales, could you give us some sense of B2B, B2C sales or, industrial and auto, what has been the sales mix and what have been the growth rates? And within auto, if you could help us understand, you mentioned there are certain segments where, market share is low. So how is, CV, passenger, two-wheeler sales mix been for us? And industrial segment, how is, the end users industries for us and what are we trying to focus on?
Yeah, so just to take up a few segments to share with you. So our B2C, what we call is basically the channel bazaar business. We have a set of distributors and we also sell to the franchisee workshops. So that is roughly about 60% of our sale. So around 60% of our volume goes into this segment, which we call B2C, which is more route to market. So obviously they sell different products. The 40% is our B2B, which also has automotive grades, but it basically talks about selling to, the OEM factory fill is like a B2B sale. Then we talk about direct industries and smaller industries. Of course, we have distributor networks, so that we call as B2B. So, and then we have one segment called infrastructure mining, which is only catering to construction companies, which is roughly 8-9% of our volume. And then, of course, we have, other segments like exports and, marine, etc., which we cater to. So if you talk about B2C, B2B, it's 60 B2C, 40 roughly. Yeah, that is how we have 55-60% is B2C, roughly what if you see the quarter-wise thing. And then within the segments, if you look at commercial vehicle oils, where we are amongst the top players, we have a very good share in certain geographies. We have a very good share with certain OEMs. So we see a lot of potential in some of the OEMs, some of the geographies, where we may be less than our 8, 9, 10%. So there's an opportunity in each segment, but to call out 2-3 segments very clearly. One is the passenger car motor oils, where we don't have too many OEM tie-ups, but we have a lot of scope because our brand is strong. And we want to really grow in that. If we are growing 0.5% market share in overall or little more than that, we would like to grow at least double of that in passenger car. So passenger car is one call-out segment, including in industrial. There are certain, pockets where our share is low, so we can grow in that. And I would say these are the 2 call-outs. And within certain segments like tractor, some geographies we will be less. So I think across the board we have scope to grow in these segments. So overall, that's what our sort of outlook is.
Sure. And if I, understand this correctly, you said, around 40% is B2B. So the industrial would fall across that? And is it fair to say that is growing faster as of now, given the thrust on manufacturing?
You are right. That is giving us very good growth. Because also we have got good products, good.
And that should grow in the near term, and that should continue to grow slightly faster than the other B2C business, right, in the near term?
Definitely.
Okay. And lastly, what is the kind of capex we've done on the EV charging segment till now?
So in December quarter, we acquired a company, which is the name is Tyrex Transmission. They are the OEM for making DC fast chargers, right from 30 kilowatt to 240 kilowatt chargers. And that's 103 crore rupees of investment we had put in that quarter in that company to get 51% share. And we have majority on the board as well. So that company deals in the fast charger space, and they have a series of customers and OEMs and bus OEMs and CPOs who are buying their products. They have more than 800 fast chargers already installed across India and running successfully. So that's one investment we have done. In addition, we have in earlier years we have done two more investments. One in a software as a service company called Electrify, and another one was in a AC slow charger company, which is a UK-based company, which is a very advanced technology based AC slow charger company. There we have some 7.5% stake. So overall, I think from Gulf India balance sheet, we have put in nearly 150 crore rupees in these three investments so far in the EV segment.
Understood. And that over a period of time, we seem pretty optimistic about the potential. And I think in the opening remarks, you mentioned around 80 crores was the EV fluid plus EV charging revenue, right? Or that was just EV fluid?
No. 80 crores was battery business. EV fluids is a very small part as the volume is also low. We have 10 OEMs. So EV fluids is quite small. Of course, in the case of DC chargers, Tyrex currently has about 8-10% market share. So based on how big the market can grow in DC chargers, we'll be looking at obviously keeping our market share and trying to obviously optimize that.
Okay, fine. Understood. Thank you.
Thank you, sir.
Thank you. The next question is from the line of Nitin Tiwari from Phillip Capital. Please go ahead.
Good evening, sir. Thanks for the opportunity. Just a few clarificatory questions from my end, sir. So, sir, in this quarter, our gross margins on a sequential basis is on the lower side. So, in the previous quarter, we did about 42.5%. This quarter, it's about 41%, but we have maintained EBITDA. So, is it right to understand that in this quarter there were fewer promotional and BTL activities, and probably we are reaping some benefits out of the activities which we undertook in the previous quarter? So that would be one. And related to that, if you could help us understand the ad and the BTL sort of promotional expenditure as a percentage of top line, if you could help us understand that first, and then I'll ask the rest later.
Yeah, so you're right. Sequentially, the gross margins are lower by nearly 1.5%, and around 50 basis point is the lower NP. Last quarter, we mentioned that we had a slightly higher NP in the previous quarter. So around 50 basis point from there, and rest is from the overall other cost and all. So yes, in spite of the slight sequential dip in the gross margins because the raw material cost and tracking crude, the base oil were at a slightly elevated level, we have been able to deliver 13.5% EBITDA. Yeah.
Secondly, sir, on the pricing front, can you help us understand abroad, basically, abroad level is fine in terms of where our headline prices are for lubricants right now and for AdBlue, and what kind of increase that we have taken in this quarter that you mentioned earlier in the call that we've taken an increase. So where the prices are and what kind of percentage increase we would have taken? Abroad level understanding would just be fine, sir.
So, see, overall on the realization side, if you talk about, and just to mention on the margin side also that, this quarter the AdBlue has been sequentially higher. So last year, this December quarter, the AdBlue volume was around 31,000, and this quarter was 37,000 KL. So in spite of a higher AdBlue contribution, our margins are maintained, or the dip is only 1.6%. So you can understand that there is an improvement in the overall core lubricant side in terms of that. And at the same time, whenever the cost goes up in the retail segment, we are in a position to pass it on to the end customer consumers. We keep adjustments to the scheme or price increases. And we have just recently taken a price increase in the retail segment. And in B2B segment, it is a matter of negotiations and approaching each customer and convincing them. This is a good part of our business. There are price variation clauses.
So, sir, I was just trying to understand a broad percentage increase that you would have taken. And is this the first increase that we have taken in this year?
Yeah, so we have not taken any price increases in the retail segment in the last 12-15 months. So this is after a gap of almost 12 months that this price increase is coming. Percentage will be difficult to tell because it is different across different product categories, depending on the market and competition.
Fair enough. And so lastly, if you could just help break down the sales in terms of sales mix in terms of motorcycle oils and PCMO and CV, sort of a slightly detailed mix would be helpful, sir.
So in this quarter, it was mostly the same as the December quarter. In terms of overall percentages, around 38-39% in terms of diesel engine oil, nearly 20% in terms of personal mobility, and industrials are also around 20%, and the rest is the others, which is gear oil, greases, and others.
Sorry, personal mobility you said is about 20%.
Yeah.
Which includes both motorcycle and car oils.
Yes.
Understood, sir. Thank you so much, sir. I'll get back in with you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to 2 per participant. Should you have a follow-up question, we request you to rejoin the queue. The next question is from the line of Arkopratim Pal from Sanjay Agrawal Broking. Please go ahead.
Good evening, everyone. Am I audible?
Yes, sir, you're audible.
Thank you. First of all, congratulations on achieving a significant result. I would like to know what is your corresponding volume growth rate, and additionally, how will product pricing adjust to impact volume growth? Could you please share your projection for volume growth in current quarter?
One is your audio is slightly weak, and second is we could not understand what the actual question is.
Am I clear? Am I audible now?
Sir, may I request you to use your handset, please?
Yeah, I am on my handset.
So can you come near to your mic and speak?
Slightly louder.
Yeah, sure. Am I audible now?
Yeah, better.
Yeah. I'm talking that congratulations on achieving a significant result. I would like to know that what is your corresponding volume growth rate in terms of product volume growth rate, and additionally, is there any price increase or decrease that can be impact your volume growth?
So we have already, mentioned our volume growth for the quarter and for the full year.
Mm-hmm.
Excluding factory fill, our volume growth is 7% nearly for the quarter, and for the full year nearly 6%. And second question is basically that whether the price increases impact your volume. Is that the right question? Right way to understand your question?
Yes.
So this is a semi-essential product. So of course it has to be used after a certain interval. People have to change oil in their vehicle, and industries also have to use it. But obviously, if there is a significant price increase, then there is maybe a tendency to shift towards lower value products in some categories. But typically, it's not a very price elastic sort of product category.
Yeah, just to add here, you see, when you look at a particular brand and a product which has a certain technical specification, the product laddering for us works in strength of our brand, our distribution. So once we have that, I guess we are clear about our price positioning. Yes, if you do take your prices up above that positioning, then you might lose customers. And similarly, if you are very aggressive, you want customers, you've got to go. So I think Gulf has a certain place in the market with the brand strength. And we are number 2 in terms of our brand in most of the categories, number 2, number 3 in some. And based on that, our positioning of price is what it is today. And I guess we don't want to really change our pricing to just get market share. We rather do it with distribution, good products, and grow as the customers are accepting us more and trying our products. So there is no, there is, as Manish mentioned, this is a semi-essential product. If you just price it too low, it's not that tomorrow customers would come and buy it, because this is a planned purchase also.
Okay, I understand. My second question is, what is your expectation for the present demand scenario?
Sorry to interrupt you, sir. Your voice is very less. Can you come near to the mic and speak, please?
Yeah, sure. Am I audible now?
Yes, sir.
Yeah. My question is, what is your expectation for the present demand scenario, and what is your strategy for further growth?
Yeah, so as we've been saying, the industry is growing at about 3%. And as we've been saying all through last many years, more than a decade, we have been growing 2 to 3x the industry. So our expectation is always to look at growing ahead of the industry. And as we look at India today with the strong GDP growth, significant manufacturing impetus, vehicle penetration levels, both automotive industry, manufacturing industry, infrastructure impetus, definitely robust domestic demand will continue for lubricants. There's a growing middle class, and we will continue to see the market growing in spite of EV coming. And Gulf would like to grow 2 to 3 times the market growth rate. So our expectation and our performance has been in line with that.
Oh, thank you, sir. One last question I would like to ask. Is there any chance in raw material prices that may affect your operation or profit margin?
So our key inputs are linked to crude oil in a certain way with a time lag of 1 to 2 months. So depending on the movement of the crude, the input costs can slightly vary, and we have to then keep looking at the margin management as a very focus area, and that's what we have been doing.
So that would be partially impact your operating profit margin if the crude oil prices go high, right?
Yeah, that's a significant input in the entire raw material cost for us. So it's not a direct crude we use the derivative base oil, and which is linked to crude.
Okay, I understand. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants, please limit your question to 2 per participant. The next question is from the line of Hardik Solanki from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So congratulations on good set of numbers. So basically, accounting question. So what will be your full year lubricant revenue and additive revenue? And have you made a significant gross margin on battery segment?
So our battery segment currently is EBITDA neutral.
Okay.
I think that was the question. We couldn't hear you properly for the first question.
Yeah. So what is the full year revenue from the lubricant and additive? If you can just give a breakup of it.
No, we only share the volume breakup, which we have already done. We do not share the revenue breakup. We have already mentioned that the full year battery revenue was around 80 crores.
Sure. Thank you.
Thank you.
Thank you. The next question is from the line of Yash Dantewadia from Dante Equities. Please go ahead.
Hi. Congratulations on the great set of numbers. Do you have any volume growth guidance for the next financial year?
I think, Yash, as we've been mentioning, market's growth expectation is about 3%. It could be slightly higher. So we've always been focusing on 2 to 3x the volume of the industry growth. And of course, the value growth, we have products which would cater to the higher value segment also. So look at a slightly higher value growth. So I think this has been our definite, outlook in terms of continued kind of performance also. And we definitely look at that kind of, band in terms of our growth.
What is our margin on the automotive segment? If you could share that number.
So you are talking of gross margins at the automotive segment versus industrial segment?
Yeah. Gross margin.
Overall automotive segment margins are higher versus industrial, but there are categories within automotive. So there is a diesel engine oil, there is a passenger car oil, there is a motorcycle. Each one has a different margin trajectory, gross margin trajectory also, and different.
Approximately, if you could net the whole automotive segment, what would the gross margins be?
No, it will be very difficult to share because then there are a lot of, ATL, BTL activities which are needed to push the automotive products, whereas B2B or industrial products are more direct. So there are selling costs associated with that also. So difficult to, quantify, but overall as a trajectory, automotive products has a slightly higher margin at gross level than the industrial.
Also, if you could just briefly tell me what raw material pricing affects your operating margins the most, if there is anything that I can track and for judging the gross margins of the company overall, what raw material affects the margins the most?
So as I mentioned in the previous question that base oil, which is our key raw material, is linked to crude. And there are global base oil indices which can be tracked by all of you, and which are publicly available data sometimes. So base oil is the key raw material which is linked to crude with a time lag of 1 to 2 months.
Perfect. I'll come back in the queue. Thank you so much for taking my question.
Thank you. The next question is from the line of Chirag Filoke from Ratnatraya Capital. Please go ahead.
Hi, thank you for the opportunity and congratulations on a strong set of numbers. Sorry, on the opening remarks, I missed the number. The core volume is 37K?
Yes, 37,000 K.
Right. Understood. And for the year, is it correct that probably on an estimated basis, the A&P spend would be around 125 crores? Is that right?
So it is roughly 3%, 3.5% of the revenue.
Understood. Got it. If I may squeeze in, and this might be sort of a repetitive sort of a question, but on the volume side, the reported number is more closer to like a 3%-ish volume growth. And I understand there is an impact of factory fill. Could you maybe talk about this a little bit more from the factory fill perspective? Is it the two-wheeler side that is feeling the stress or the four-wheeler? Because some parts of the market are putting out good production numbers, which should correlate well to our factory fill. Because 3% on an overall basis is on the lower side. Is that true? Is that what would be a good estimate from your end also? Just a little bit more color on the volume growth. That's all. Thank you.
Yeah, so that's a very good question. I think we also mentioned that roughly total 10% of our volume is coming from factory fill, and it is largely from commercial vehicle segment. We do not have any major factory fill in the motorcycle or car segment, which is obviously doing very well. And we have seen that the growth in motorcycle, two-wheeler is nearly 13% for the year in terms of vehicle, and car is also almost near the double digit. But commercial vehicle in the last 2 quarters have been slightly lower in terms of production, commercial vehicle OEMs, and that's where we started getting some hit in terms of our overall volume growth. But excluding that, as we mentioned that for Q4 our volume growth is nearly 7% in the core lubricant, which is clearly towards the market. Because OEM production we do not have any control. So if they produce less, we have to sell less.
Correct. That makes sense. And in the base March 23 quarter, was factory fill also around 10%? So was it around 3.5 KL?
Yeah, it hovers around that.
Understood. Thank you. Thank you for the opportunity.
Thank you.
Congratulations on a great set of numbers.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask questions. The next question is from the line of Varun Arora from B&K Securities. Please go ahead.
Yeah. Hi, sir. Thank you for the opportunity. I'm audible, right?
Yes.
Yeah, thank you, sir. So I just want some two clarifications. First on PV market share. So we are holding 5% market share. Is that correct?
Around. It's slightly less.
Slightly less.
4 to 5%. Yeah.
Okay. And the next question is on the, so you're saying that after 15 months later, you have taken the price hike. So how much was that? I mean, in the percentage terms?
So we mentioned that it is depending on category to category. So depending on the competitive actions and overall market scenario and our input cost, where it has gone up in which product category more, we try to then take the price increases. So overall in the range of around 2%, but varying between categories.
Okay. Okay, fine. So just now on data center. So anything the companies in the Gulf oil is doing, since the Europe actually doing something on that technology on the data center. So anything we are doing on developing any products on the data center. So since after maybe 2 to 3 years or maybe 4 to 5 years, this will be the humongous opportunity for the company. So any
yeah, you see, the data center is definitely a buzzword we are seeing all around. So we are looking at that segment, but it is an evolving segment. So definitely that is an area which we want to look at.
Okay. Sir, thank you. Thank you.
Thank you. Thank you.
Thank you. The next question is from the line of Arya Patel from MK Global. Please go ahead.
Hi, am I audible?
Yes, sir, you're audible.
First of all, congratulations on the great set of numbers. Sir, I just had a question regarding what is the capex mandate for the FY24, and are we planning any further capex in EV or going ahead?
So our usual capex in the lubricant, core lubricant business is roughly 20-25 crores, which we have been guiding about. And last year also we have spent nearly similar amount. And we will continue to do that in the current year as well. This is to our augmenting some of the filling capacity and storage capacity around, the lubricant part. And in terms of EVs, we keep evaluating at the space. It's a very nascent space and evolving space. So we keep exploring opportunities in the EV side where, based on our strength of brand and distribution, how we can play a bigger role. Because while we know that the lubricants and the ICE market, ICE vehicles are going to continue to grow, but there will be a certain percentage in certain categories which will be, converting to EV at least to some percentage. And that's why we closely keep watch at the EV space, and we keep exploring the opportunities there. But no yet any, whatever we have done already is towards the charger manufacturing, AC charger, slow AC charger, fast DC charger, software company. We have already done 3 investments, but we keep looking at this space.
Thank you. And one more question. Sir, can you guide us on the base oil trends currently?
So base oil follows crude, as we have mentioned in earlier questions, that it went up to above $90 recently, and then now has come back to around $83, $84, which is a good sign. So it will be, as long as the crude is in the range of, below $90 or around $90, $92 also, we see stability. And unless the geopolitical situation turns really ugly, we believe that the crude will be in this range, and that should augur well for the stability of the margins.
Got it, sir. Thank you so much.
Thank you.
Thank you. A reminder to all the participants that you may press star and 1 to ask questions. The next question is from the line of Misha, who is an individual investor. Please go ahead.
Hello, am I audible?
Yes, ma'am, you're audible.
Thank you. Thank you for giving me the opportunity. I just have 2 questions. So there is a steep increase in the other expenses on a full year basis by approximately 18.5 to 19%. Could you help with some reasons around that, sir?
So a large part of it is coming from obviously the A&P, which has been higher, which is the advertisement and promotions. And also, since our volumes, including AdBlue, has gone up, it is freight has also gone up. So these two contribute a large part of it.
Okay. And sir, you mentioned in your press release that your export has picked up really well in this particular quarter. So what is the total percentage of export on your core volume, if we will get that?
We usually have around 5 to 6% in terms of export in our thing. This quarter was slightly higher because some of the OEMs for which we export has been good. But overall, it is in the range of around 5-6% of our core lubricants.
Understood. And the last one, sir, on the balance sheet, we exclude the cash and cash equivalents balance. There is a slight deterioration in the net working capital that we have. So could you throw some light on how has been the working capital performance over this year?
So working capital has been quite stable. Overall, we continue to track in the range of around 105 days of gross working capital, 105 to 110 days, which has been our sort of band in the past trend.
Okay, sir. Okay, that's it from my side. Thank you.
Thank you.
Thank you. Ladies and gentlemen, you may press star and 1 to ask questions. As there are no further questions from the participants, I now hand the conference over to the management of MK Global for closing comments.
Thank you so much. Just to close off on the outlook, of course, let me thank everybody for being on the call. As we see, the demand conditions are quite strong, given the economic GDP growth, the kind of thrust in terms of the manufacturing sector, infrastructure will pick up now post-elections. I think we are seeing strong growth potential for the industry. We have also already detailed in this call that segments which are doing well for us and potential for us to grow in segments we are having lower market share. The brand we have is quite strong, so both increasing distribution and increasing our customer base is the endeavor. We have always said 2 to 3x the market growth, which for us is a strategic focus. We are committed to outperform the industry growth rate. We also want to look at value growth, which is above that. Effective margin management, profitability, and maximizing returns to shareholders has always been our mantra. And in the outlook, of course, as Manish has also mentioned, we are looking at EV space, not only to grow our charger business, but to look at maybe some other investments. We are going to focus on growing ahead of the market in the strong product segments like diesel engine oil, motorcycle, and even higher aggressive growth in segments where we have less than 5%, to mention few like industrial and passenger cars. Series of new products have been launched, and now definitely we seeing these being accepted by consumers. Our brand investments continue. As we mentioned, we have invested. We have a lot of our brand investments into sports, into brand ambassadors like Mahendra Singh Dhoni, Hardik Pandya, Smriti Mandhana. Globally, we are doing racing with Formula 1 and, of course, Chennai Super Kings. Our activities both above the line, below the line have given us great results. So I think this is the outlook that we continue, and having had the quarter which has done really well, really happy to share that with all of you and hope we get your support going forward. Thank you so much.
On behalf of MK Global Financial Service, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.